Welcome back to another episode of Mindful Money Nuggets, the podcast where we explore practical strategies and philosophical insights to align your finances with your core values. I'm your host, Traci, and today's episode promises to be an insightful one. Joining us is a very special guest, Russell Kamp, CEO at Ryan ALM. Russ brings decades of experience in pension fund management, and he's here to help us uncover how the lessons from managing large institutional funds can transform your personal financial planning. Today, we're breaking down some of the fancier financial language to show you how the same principles of time, cost, return on investment, and risk apply to your own money. Whether you're managing a household budget or saving for retirement, the principles of risk management, long-term planning, and disciplined investing are your allies. We'll also discuss the human element. Your gut feelings and understandings of your own risk tolerance is essential, even in an age of AI-driven financial tools. Russ, thank you so much for joining us today.
Oh, it's my pleasure, Traci. Thanks for having me.
I'm really thrilled to share your insights with our audience because I truly think this is an opportunity to share the similarities in the institutional investing and personal financial space. So, having worked with large pension funds, you know the importance of disciplined investing. What are some of the key principles from that world that everyday investors can use to improve their financial planning?
Well, I think even before we jump into that, Traci, we just need to realize as individuals, the people who are administering these plans are individuals just like us. They have the same concerns that we have on a day-to-day basis in terms of being able to create a bucket of wealth that'll help them in their golden years. So, they have the same biases that we have. They have the same issues that we have in terms of, finding appropriate funding to be able to actually accumulate some wealth. And so whether you are a corporate pension system and the plan is being administered by an assistant treasurer or a treasurer or chief financial officer, or a public pension system, which is probably even more appropriate because in many cases the trustees of those boards are firemen and policemen and teachers. They're just like us. And, even endowments and foundations that are trying to either support specific programs or run universities, they're also being administered by individuals that come to the table with biases. I think the biggest difference is that when you're talking about a pension plan, it's a little bit more structured. Okay, they've made a promise to a plan participant that if they work a certain amount of years and they earn a certain amount of money, they're going to generate a certain amount of benefit each and every month. And in order to ensure that they've accumulated the wealth necessary to meet that promise, they start off by developing a financial plan similar to what an individual would have to do. Now, that financial plan is referred to as an investment policy statement, but it could easily just be, here's XYZ's financial plan. What they're going to address is the same thing we're going to address, is what are the basic needs that we have in the plan? So what were the promises that were given? How do we accumulate the wealth necessary to actually meet those obligations? And then what are the investment objectives that we're going to utilize to actually get us to a successful outcome? And so that investment policy statement is a living and breathing document, just like your financial plan would be. On a daily basis, you're going to be looking at that financial plan to make sure that you have set the appropriate goals and that you're on target as you move through the plan. Same thing for a pension system. They're going to look at that investment policy statement. They're going to make sure that the goals that were established early on still make sense. And are they actually on a glide path towards that full funding requirement to meet those promises?
Yeah, I really love that you made that point that, as I said in the beginning, it can seem like in the investment world that they're using really fancy language, but at the end of the day, we're all saying the same thing. And it can be as simple as just risk and having a plan, understanding what your liabilities or your expenses are, and how you're going to cover them in any given time period.
Well, that's exactly right. As an individual, you have a certain number of obligations that are non-discretionary. All right, so hopefully you have a house or you have an apartment that's housing you, and there's an expense associated with that. You also have the obligation to put food on the table, insurance. If you can save for retirement, great. But all these non discretionary items need to be funded. And so your financial plan needs to take into consideration those first and foremost. Just like a pension system, a pension plan has three different levels of obligations. They have those that are currently being paid, they have active employees, and then they have what are called terminated vested, or people who used to work at the organization that actually worked long enough to acquire a benefit but haven't retired yet. And each of those have a different time frame. And so you need to match up your assets with the time frame, just like you do as a financial planner and just as you do as an individual with a financial plan. You know what has to be paid next month. You know what you'd like to do in a few years. And boy, wouldn't it be great to have the vacation of a lifetime, right? Or a second home, or make sure that your children have a college nest egg that's going to take care of their expenditures. But you have to prioritize each and every one of those, just like a pension system has to prioritize their payouts. They're going to pay each month those that are currently retired. That's easy because they know what they're paying out. It's the future obligation that creates some uncertainty. So they're going to build, hopefully, a program that meets those needs today, but also builds for the future, just like an individual would.
Right. I call it the cost of being you. Right?
I love that. That's great. And each of us has different cost structure.
For sure. For sure. And I think one of the things that is a key point that I like to make is that in a pension system, they're really doing a lot of homework on looking at the future liabilities, those payments that need to be made to those retired and or soon to retire people. And I, on the personal side, like to think of that as those less frequent but predictable expenses, and they need to be factored in.
Yeah, I mean, I think if you are developing a financial plan, whether you're talking about a pension plan or an individual plan, you're going to have a triangle. And at the base of the triangle are going to be, again, those non-discretionary items that are going to take up the bigger chunk of your wealth, your ongoing expenditures. And then there's going to be a second level, which to your point are less frequent payouts, but still obviously necessary. So if you pay only once a year for insurance, for instance, whether it be for your home or your car, that expenditure is going to be at that second tier. And then you have the educational costs, and then you have the nice to haves at the very top of it, so that as you're building your wealth, you're accomplishing each and every one of those objectives till finally that triangle is filled in. But again, you can't get to the top, you can't get to that wonderful vacation, right, without having actually built the wealth necessary to support that whole triangle.
Yeah, one of the questions that I ask my clients a lot is what goals, large or small, are you prioritizing? And that really it's a simple question, but there's a powerful impact on that.
Absolutely. I mean, it's unfortunate. I mean, I've read studies, as you have, that, a good chunk of the American population couldn't handle a $400 emergency. It's something like 63%. It's really frightening that, God forbid, they had either a health emergency or an automobile repair bill that was unexpected, that they'd have a difficult time meeting that. I mean, and that's how challenging our current environment is for most of us. And it's not that they don't know what they have to do. It's just that we're constrained in many cases because of all the expenditures that have been laid on top of it. And it's getting, it was challenging for me. It's getting to be very, very challenging for the younger generations that are now faced with a lot of expenditures and a magnitude of expenditure that I didn't have to worry about.
So can you share some of the lessons from managing large funds that surprised you and how it might apply to someone managing their own financing?
Oh, absolutely. I mean, I've been very fortunate to be doing this now for over 4 decades, and there are a number of examples of things that absolutely surprised me. So back in the 80s, for instance, we had a client, it was a defense contractor. We went through early stages of 1987, and you may recall that the S&P 500 was up over 50% of the time going into the end of September. And then October 19th hits. And October 19th, the market collapses. October 20th, it's even worse. It's down something like 23%. And at that point in time, I was young in my career. I wasn't quite sure what was going to happen to me personally, but what was going to happen more broadly was even more frightening. And we had a client, as I said, a defense contractor, that sold at the bottom and migrated a tremendous amount of assets into gold. They had created in their own mind that there was this doomsday scenario that was evolving. And so they took a huge chunk of the pension system and bought physical gold. Now, at that point in time, the market had already collapsed. You'd already lost that. So now you've locked in those losses, which is really unfortunate. But worse, you've migrated to a commodity that doesn't kick off any income. There's a cost to hold it. It was just a very strange situation that evolved. And again, it gets back to us being human beings. The defense contractor, the people who worked there, had a certain mindset. They were anticipating something beyond what I was anticipating at the time, and they thought they were doing the right thing. So their biases crept into the decision making. And so it gets back to, again, I think that investment policy statement or that financial plan that will help you migrate through some of those very challenging periods of time when your personal beliefs and biases might overwhelm what would be the best practices. And again, selling after a market decline like that and migrating into a physical gold proved to be disastrous for them. It was really quite unfortunate because markets snapped back fairly quickly. The year ended up still positive, and from that bottom of the market to almost 2000, it was straight up from there. I mean, it was really kind of an incredible run. So if they had had a discipline in place that said, market hits the bottom of my range for equities, instead of selling, I'm now going to be forced to buy to bring it back to policy normal level, then maybe they could have avoided that. I'll give you another example. I was working with a state organ, a very large state, and going through the great financial crisis in 2008 into early 2009, they decided to take a significant sum of money, I think it was something like $14 billion, at the bottom of the market, so just before April 9th, or March 9th, I guess it was, and they migrated about $14 billion into hedge funds. So the question what one should ask is why at that particular time when the S&P had already declined almost 50%? Again, now you're locking in those losses. What were you going to be hedging at that point in time other than future performance, right? So instead of basically buying low and then eventually selling high, they were selling low, buying a bunch of hedge funds. Well, we know what happened. Following the great financial crisis until today, it's been pretty steady. There have been a few blips here and there, but the market's had one of the greatest bull market runs in history. And they eventually, a couple of years ago, sold out of half that hedge fund position at basically a significant loss. So you could have bought cheap beta, being the S&P 500, for a few pennies at a 50% discount, but you bought expensive hedge funds that only ended up hedging future performance. It's just examples like this that get back to, if you have a plan in place, don't violate the plan. Don't overrule the plan. You have to make sure you adhere to it, because this is what's going to be guiding you. And it's easy, again, as individuals. We come with all of our concerns, our fears, our biases, and we can allow market environments and market events to overwhelm us. And that's what we need to try to avoid. And that's the basis for having a plan in the first place, so that we can eliminate all of the psychological impact on our day-to-day.
Yeah, it's about avoiding the emotional decisions during market volatility and having a plan in place or guardrails that you use so that you can navigate those bumps in the road, which are inevitable.
Again, we're all taught you want to sell high and buy low. I mean, it's a very easy concept to understand. But when markets are trending down and in some cases collapsing, it proves to be very challenging to adhere to that. So again, if you had a long-term plan that said, I need to earn X over some period of time, and in order to accomplish that objective, I'm going to have so much exposure to domestic equities and domestic fixed and some alternatives and blah. And I'm going to have bands, as you talked about, around each of those things. Once that band is violated, and, if all of a sudden the lower band's being touched, now it's time to reinvest. If the upper band is, and it's just as difficult when markets are going through the roof to say, oh, I'm going to take some risk off the table now because, markets are just going to keep going to the heavens, right? Well, it doesn't work that way. So you have to have the discipline both to buy low and to sell high. And so take some chips off the table. Even if you own NVIDIA and it's the only stock you own and you know it's going gangbusters, once that goes through your upper band, folks, it's not easy, but pull back. Either that or find a reason to change the investment policy and have that going forward. Because investment policies can be changed. Your situation can change for whatever reason. And so it needs to be reflected in that financial plan or the investment policy statement.
Yeah, so in my work, I emphasize the importance of identifying core money values, and I kind of use those as the investment policy statement because they are really similar in my mind. Because when you have a compass, so to speak, that you're working from, I really believe that it both informs the decisions you make on investments, but it also informs the decisions you don't make, right? So it's like it informs your spending and it informs your savings. And
yeah, listen, it's great to have a financial plan, and we know things change from time to time. Unfortunately, people lose their job or become ill or something happens, and that's why you need to be able to review that plan on a regular basis and amend it as necessary. And if for whatever reason your long-term objectives have to be brought down a little bit, well, you know what? That's fine. It happens to all of us. So then you revisit it as things improve again. And so, but again, it helps you eliminate the emotional aspect of what we do on a day-to-day basis. And there's no certainty in investing. That's the other thing. And so what people need to do is, if they can, is to bring a level of or an element of certainty to the whole process, at least for a portion of it. I mean, that's what I try to do in working with pension systems, and that's what individuals should do. At least to meet those minimum requirements, there should be an element of certainty. And then all of the volatility should be used for the long term, that longer time horizon, to meet those future needs or goals or desires.
Yeah, I love that. I really think it's important to think about the longer term horizon as well as the current environment. On the investment side, when I work with clients, we don't do we look at short-term planning, but we're always looking for the longer term payout when you're looking at the investment side of the plan.
Yeah, no, it's listen, most pension plans to this day have all of their eggs in one basket. They've determined, however they've done it, working with their actuary, their asset consultants, their board, that they need 7%. And they're going to put all the assets into a single basket. It'll be well diversified, but it's all going to be with the idea that collectively we're going to get to 7%. Now, what they fail to understand is that 7% on a one-year basis comes with just significant volatility. And what they need to do is they need to extend the investing horizon so that when you get out to 10 and 15 years, that volatility is much smaller. And then the probability of achieving your desired outcome is much greater. So if you could split your assets into two effective buckets, one being a liquidity bucket that brings certainty to the near-term needs, and then a more aggressive growth bucket to grow unencumbered now because it's no longer a source of liquidity to meet those longer-term future needs. Because again, if you give an investment process or product a 10-year window, instead of us looking at it on a day-to-day basis and, fretting over market moves that are just normal, if you give any of those products a 10-year, runway, the likelihood of achieving your long-term success is going to go up greatly. But we live, just as in pension plan land, we live on a day-to-day, quarter-to-quarter, year-to-year basis, and that volatility that we witness leads to a lot of decision-making that may not be the most appropriate.
Yeah, going back to the emotional decision making, right?
I mean, if we put it, so you develop this investment policy statement, you build these forecasts for a 10, 20, 30-year window, and then you ask individual investment managers to come in every single quarter and talk about why they underperform their objective by 15 basis points. It seems really silly. So if you actually had a program in place as an individual or as a professionally managed institution where your near-term needs were certain, you were able to actually match up your asset cash flows and your liability cash flows for some period of time, 5, 7, 10 years. And now all those products and all those great investment management teams that you hired, and you just said to them, okay, we're going to evaluate you in 5 years or 10 years. It would make everybody's life a lot easier. But again, we fret over inconsequential underperformance of a few basis points over some period of time. I mean, it's arbitrary, a quarter, a year, 18 months. If you hired them in the first place because you believed in the process and you believed in the team and you needed exposure in that area, then give them the appropriate time to actually achieve their objectives. I just think that we create way too much turnover and expense. There's a lot of expense associated with flipping in and out of managers for pension plans, but equally important, flipping in and out of either ETFs or mutual funds or any of those things. So, we just need to be a little bit more patient and allow the program we've put in place to actually work.
Yeah, this brings us to one of the critical investment tools we have, which is time. And I know time is such a critical component that I would love for you to help our listeners understand how time plays into the concepts, like the time value of money or compounding interest or whatever else you have to add.
Yeah, absolutely. So again, I was taught early on that the investment horizon that you're operating under it's going to really determine what you should invest in. If you told me I only had a quarter to invest, well, guess what? I'm investing in T-bills because I want certainty, or I might even just put it into a bank CD. I want the certainty of knowing I need that money in 3 months. If you tell me it's a year, maybe I can invest in a bond. If you tell me it's 10 years, well, now the investing world is open to me, right? Because now I can absorb all of the ups and downs over that time frame, especially if I'm not going to be looking to it for any liquidity purposes. So when we work with pension systems, what we're trying to get them to understand is that they have short-term needs just like an individual would. You have a promise that's in the form of a benefit payment, and you have expenses that you incur in order to meet that benefit payment. Both of those can actually have asset cash flows matched off against liability cash flows. If I know that over the next 10 years I have X amount of money I have to pay out, I can take a present value calculation of that future value promise and literally defease those liabilities so that the asset cash flows and liability cash flows move in lockstep. With the volatility that's associated with a 1 year, 2 year, 3 year time frame, if you could eliminate that, you're going to bring far greater certainty to your individual plan or to the professionally managed institutional plan. And that's what we're all about, trying to raise the level of certainty in a highly uncertain world. We ride that roller coaster of returns up and down all the time. And I don't know if you remember, but Hurricane Sandy that hit New Jersey back in 2012, on the Seaside Heights boardwalk was a roller coaster that ended up in the Atlantic Ocean. And there are tons of pictures of it just sitting there, half submerged. And to me, that's representative of how institutions run their asset allocation. They ride markets up, they ride them down, they ride them up, and eventually they get all wet. And, they don't take money off the table at the peaks. They let it run. They don't put money in at the bottom. All right, they never double down. I mean, again, in many cases, they're just not adhering to their own investment policy, but they're also not adhering to just common sense. Markets run through cycles. Nothing goes up forever, but nothing tanks forever either. And so if you understand what drives the cycles, you can capture that insight and use it to your benefit, just as an individual should. Again, it's not easy, It's being a contrarian is very tough. I've read a lot of books on human behavior, and I've used that in some of my stock selection criteria. It's equivalent to biting off your left arm, being a contrarian, being outside of that herd. So that's how painful it is. We understand that. But if you have a plan in place, it helps to mitigate some of that.
Yeah. So on the time thing, I wanted to try to draw a correlation that when you start earlier in your investment process and you have a plan in place and you're consistent with it, you have a lot more time to weather volatility or said otherwise, risk in the market.
Absolutely. Yeah,
Yeah.
no, I mean, again, depending on how you've structured your program, you can. So, what we talk about is what we do as being the bridge over troubled waters. I won't start singing. I love the song, but I won't
I
do
love
that.
this song too.
I won't do that to you. But I've written about that. And what you want to do is you want to have a program that helps you actually bridge those difficult time frames. And the longer time that you can provide your growth assets without having them be a source of liquidity, the more of that volatility you can avoid. And so, again, if you bifurcate your assets into a liquidity bucket that meets all of your needs, short term, intermediate term, and then have these growth assets meeting your longer term needs, that's one way to accomplish the objective. And if you can do kind of what we do, which is cash flow matching, then you're doing it with certainty because future values, so those future promises or those future goals, they're not interest rate sensitive. If I needed $1,000 next month to meet a benefit payment, or you needed $10,000 10 years from now to meet some obligation, you could take a present value calculation based on today's current rate environment of what you need today to have it grow to meet that objective 10 years out. It's what insurance companies have always done. It's what lottery systems do. It's what we do. It's just math. And it's very straightforward. And it creates a certainty that's not found in most markets, if any.
Yeah, I really love the concept of having two buckets, your liquidity bucket and your growth bucket. It essentially separates your short-term needs from your long-term needs, as you said.
Right. And as you move through your plan, the allocation to those two buckets can change. So as a pension plan becomes more and more fully funded, the need for them to take risk becomes less of a concern. So they should be migrating more and more into a discipline, as I'm talking about, cash flow matching, and removing a lot of that uncertainty so that when they finally are fully funded, now they've actually secured all of those promised benefits with very, very little a chance of risk. Just as an individual, as you're building your wealth, and you have an extended time frame. So if I'm a new employee and I'm going into a 401k plan, whether I can only put 1, 2, or 3% in doesn't matter. You have to put something in. Let that compound over time. But as you're migrating through your 40-year career, you're naturally going to be taking less and less risk as you're getting closer to retirement because you don't want to jeopardize in the last couple of years what you've been able to accumulate. Now, it doesn't mean you shouldn't have any equity exposure because obviously inflation still exists. We know that in spades following what happened during COVID. So you need to be able to continue to maintain the purchasing power of your retirement assets. But you also don't want to subject the entire asset base to risk. So you need to understand where you are in your life cycle, where you are in your investing horizon. And the shorter the investing horizon, the less risk you want to take. The longer you have, you can take more risk. You may not be comfortable doing that, and that's fine. Everybody's got a different risk return profile, but it affords you the opportunity to do that if you're comfortable taking more risk.
This is a really important point that I want to circle back to, or at least make a pin in, that you talk about your life cycle, and we have more liquidity needs as we get older, right? As we enter into retirement, obviously we need the money to be liquid. And I think it's a good time here to talk about this is why having a financial advisor can make a real big difference. I think it's important for our listeners to understand that these institutional funds that we're talking about have lots of professionals that work on them, and they have a whole team. And it really helps to have somebody who is in this world every day help you make decisions. I will also mention there are financial advisors out there that have no minimums. They may be harder to find, but there really is a financial advisor available to anyone who has a retirement.
I think that that's absolutely correct. And I think, again, your financial advisor is there as a sounding board to understand your objectives, to understand your risk return profile, to encourage you to do the right things. Contribute when you can. Don't buy high. Don't chase performance. Don't sell low. Don't get out of the market entirely. Use your ranges that you've established to set the minimum and maximum exposure and help you transition during periods of uncertainty. I mean, they're there to guide you, but they're also there because of their experience to help you weather some of those more challenging environments, to just say, hey, we've been here before. We know that markets go through cycles. We know that this is going to get better. The last thing you want to do is abandon your plan right now. You can alter it depending, again, on what happens on your day-to-day life. I mean, things do change, but let's not abandon it. And I think having somebody there to encourage you is critically important. As you said, no pension plan that I'm aware of is doing it on their own. They have actuaries who forecast what those promises look like in the future. They have asset consultants to help them structure an investment program that's going to meet their long-term objectives. They have trustees who are responsible for implementing the program. They're responsible as fiduciaries to make decisions in the best interest of the fund. So you're right. I mean, they have custodians who are responsible for for holding the money and making sure it's there. Lawyers to help make sure that they don't do something that would be inappropriate. So there are a ton of people who are working with them, and yet, despite all of that, they're still human beings. They still have biases. And, we know of pension systems that are not doing as well as they should. There are a lot have done a great job, whether you're talking about unions or public pension systems or private plans, that are doing phenomenally well, that are fully funded, that have made the contributions as needed, when needed. But there are others using the same tools, same service providers who are not doing well. And again, in many cases, they're just violating their own internal guidelines, their investment policy. They're not contributing when needed. They may be taking too much risk. They may be abandoning their plan at the wrong time. So even the best funds with the most sophisticated support can fall prey to some of the things we've talked about today.
Given your background in institutional finance, what trends are you currently seeing in the market that everyday investors should be aware of?
There have been some pretty significant trends. Some of them scare me, and some I think are a huge opportunity. We had an interest rate environment from when I entered back in 1981, where the 10-year Treasury was yielding close to 15%. Now, I was neither smart enough nor did I have more than two nickels to rub together to project out the next 40 years all the liabilities that I might have incurred to be able to defease those liabilities 40 years ago at 15% interest rates. But then we saw interest rates collapse. So that 15% 10-year Treasury yield back in 1981 became about 50 or 60 basis points in 2021 when COVID hit. And so that had huge implications for risk assets. It had huge implications for pension plans whose liabilities now all of a sudden were being discounted at ridiculously low interest rates, so it made them look huge relative to the assets. That interest rate environment, has changed dramatically at this point in time, which is great. So we now have a 10-year Treasury yield at about 4.7, a 30-year that's just under 4.9 right now. Investment-grade corporate bonds are yielding between 5.5% and 6%. So you can actually put together a liquidity bucket that we talked about before that will provide you with some pretty healthy returns relative to your long-term objectives. So if you're striving for 7 as a pension plan, because that's what you need to fully fund your benefits, and you can get 6 through investing in a bond portfolio, well, you've almost accomplished all the objective with minimal risk. So that's the positive side of what we're seeing in the environment right now. And a lot of corporate pension plans have migrated significant assets to fixed income for that reason. They're close to fully funded, they can take risk off the table, they can defease those liabilities at attractive rates. On the other hand, the plans that are not well funded, who are chasing performance, have migrated significant assets into the alternative space. Whether you're talking about real estate, private debt, private equity. And what we're seeing is, I think, the asset class is being overwhelmed. Now, there are a lot of reasons why real estate has come under some stress. Obviously you had COVID and you had people not working in the locations, and it really had a major impact. Now, that may be changing a little bit. But again, asset classes benefit from cash flow until they don't. When all of a sudden you've overwhelmed an asset class because too much money is chasing too few good deals, you bid up the good ones to such an extent that future performance is eroded. But we're seeing that at a pension land. They've overwhelmed private equity. And within private equity, they're not getting the distributions at this point in time. We don't have a very active IPO market. And so the results that were forecasted have not been there. Private debt seems to be the darling of everybody at this point in time. But how much capacity is there really in there? What's the natural capacity in that strategy? And are we on the brink of potentially overwhelming that? And so again, you need to be mindful. Just because an investment makes sense longer term doesn't necessarily mean it's a good investment. We've seen that with stocks. Great companies don't necessarily make for great stocks because the fundamentals of that underlying company right now just may not be attractive. We have a U.S. equity market, large cap growth, dominated momentum style because of the technology exposure. Well, how much further can that run before all of a sudden it rolls over? Small value has underperformed large growth dramatically. Is it time to shift some money back? The U.S. market has overwhelmed all of global markets in terms of performance. And so is it time to perhaps take some risk off the table from the U.S. and migrate over to the international marketplace? If you have an investment policy or a financial plan that has allocations to these, and you have bands around these, I would imagine that a lot of these bands are being touched right now. Domestic equity should be, if not through, certainly lapping against the top of that band. If you have an allocation that says we're going to have small value, it's probably touching the bottom. And it forces you to make a decision, and you should be listening to that because markets, again, don't go to the heavens and they don't collapse. So they underperform, and we saw it back in 2000 to 2002. The NASDAQ fell from peak to trough 83%. Probably looked like it was never going to come back, but now, of course, it's gone up dramatically. So use your investment policy to help understand what's going on in markets, because that policy range has been set for a reason. If all of a sudden something looks like it's getting out of whack, it could be that we were at extreme levels.
Well, Russ, today's conversation has been great, and I really believe that it's been educational for the listeners, and I really thank you for giving us a peek inside how institutional investment principles, like we mentioned, cash flow, well, we didn't really talk about it specifically, but the cash flow matching, the risk management and time can empower everyday individuals to take control of their financial future. Oh, and let's not forget about core values.
Right, absolutely. No, this was great. I really appreciate the opportunity to speak with you. It's a pleasure. And hopefully some of the insights are going to be proven to be useful. And if I could just mention, I also write a blog. And so I've written over 1,500 posts on my blog. And there may be some useful insights there as well. So
I think there would be. We'll definitely link it in the show notes. But if you want to tell people where to find you, that would be great.
Well, thanks, Traci. It's pretty simple. It's just Kamp Consulting Blog, all one word. So KAMPconsultingblog.com. And if you have any questions, please feel free to email me. I'd love to respond to any questions or challenges.
So to our listeners, if today's episode was inspiring, For you to take charge of your finances, visit our website to schedule a free discovery call. If we can't help you, we'll provide you with resources to point you in the right direction. And don't forget to subscribe to this channel for more mindful money tips. Thank you again, Russ, for sharing your expertise, and thank you to our listeners for tuning in. Remember, financial freedom starts with the definition. Until next time. Bye.